And I've been doing quite a lot of research on impact investing since joining Wharton. And this presentation is just a quick showcase of some of our latest findings from a major project that I think are thought-provoking and worth sharing as quick as possible with the field, rather than waiting for the onerous process of peer review and all of that. So this is sort of a sneak peek of something that might be a larger project in the future, but just hoping to gather feedback and input from practitioners and other experts as we're kind of figuring out what these data are saying.
And so, Michael, if I could just jump in and ask everybody to add your organization name to your name in the participant list so that Michael has a sense of who all is in the room. Thank you, guys.
Yeah. And if it's okay with everyone, what I'd like to do is, the presentation I think will take about 20 minutes. And then I'd like to just block off the rest of that time for Q&A. So if it's okay with everyone, I'd like to just kind of get through the presentation without taking questions while I'm presenting. And then I'm happy to have a full conversation afterwards. So I'll go ahead and share my screen. Okay. So, the title of the presentation is "Should Impact Investing Be Hard? Thinking About Difficulty When Evaluating Impact Investor Contribution." And everyone can see this cover page, right? Can I just get a thumbs up from? Great. Okay. So to set some context for why this question is important, I'd like to start this presentation with some data on the popularity of impact investing as a Google search term. So here's the graph. You can see the emergence of the term following the famous convening at the Bellagio Conference Center in 2007. And then you see pretty impressive growth until around 2018, when it clearly starts to level off. So the shape of this line suggests that the growth and popularity of impact investing has plateaued to some extent in the past few years. And you can see this in other data I've seen as well. So to make sense of this plateau, I'm going to add a line for the search popularity of ESG. Okay, so now you can see the two trends together with ESG there in orange. And bear in mind, these are ranked data, so the lines are sort of on different scales. So you want to look at the shape of the lines, not the heights. So this graph is not telling you that impact investing was a more popular search than ESG was in 2015, for example. What it is telling you is that there was a surge of interest in ESG that coincided with the leveling off of interest in impact investing, at least as measured by Google search popularity. Now, from my perspective, this fits with what I'm hearing and sensing in the field from my conversations with impact investors. There's clearly growing interest in ESG, and impact investing is starting to get overshadowed to some extent, it seems. Just on a personal note, this trend shows up in my own organizational affiliation. Until somewhat recently, I was employed at the Wharton Social Impact Initiative, which was focused very much on impact investing, but has now been restructured as part of the Wharton ESG Initiative. And to be clear, I'm still excited to be part of what Wharton is doing in this space, and we still have an impact investing research lab, but it's now part of a larger center focused on ESG. And I think I'm not alone here when I say that the growth of ESG, as shown in this graph, has been really exciting. But this tremendous growth also raises the question of whether impact investing is getting lost in the sauce here. Now, there has long been the question of what really differentiates impact investing from ESG. As I think most of you know, and as shown here, there's no shortage of infographics and frameworks that try to get across this distinction between ESG and impact investing. But frameworks aside, I think most of us would acknowledge that there has been an effort to keep a big tent approach in impact investing, even at the risk of fueling this ambiguity over what is impact and what is ESG. So taking a relatively inclusive approach, not scaring off or alienating too many stakeholders, that's been a clear and important strategy for building the field of impact investing. But I think that looking at this graph again, now might be the time to really reflect on whether impact investing needs to assert and differentiate itself a bit more, even if it means rethinking that big tent approach. Because the fact of the matter is that many people are confused about where ESG shades off into impact investing. And as long as there's that ambiguity, I think that practitioners and others will understandably just opt for the term that reflects greater market share. And so that's why I think the popularity of the concept of ESG seems to be coming at the expense of the popularity of the concept of impact investing. And this is where we need to talk about contribution, or additionality, as some call it, because the idea of contribution is all about what differentiates impact investors from other investors. Okay, so it might be useful to do a quick refresher on what contribution means as a sort of a term of art in impact investing. So I'm going to defer here to the website for Impact Frontiers, not only because they're hosting this talk, but also because they've done a great job of informing and improving practice in impact investing. So in the recent draft for public consultation on definitions and strategies for investor contribution, the Impact Frontiers team puts forward the following definition, which I think is quite good. So I'll just read it really quickly. Investor actions that cause or are expected to cause a change in outcomes for end stakeholders, the natural environment, and or systematic risk that would not have likely occurred in the absence of those actions. So basically, we're talking about counterfactuals. Okay, we're talking about impact that we have good reason to believe would not have occurred if the investor had not made the investment they made in the way that they made it. And just to flesh out this definition, the Impact Frontiers site has a really important contextual note, which I'm also going to read over really quickly. Enterprises and investors operate in a dynamic social system with various actors, from competing firms to government bodies to NGOs, seeking to contribute to the same set of outcomes. So just to unpack this, the context for understanding and assessing contribution is that there are other actors in the market that also contribute to social and environmental outcomes. And so the idea of contribution is to take stock of this broader ecosystem and to determine, based on that contextual awareness, what unique impact value add an impact investor brings that justifies that title of impact investor. So in short, the theory is that impact investors are supposed to go where other investors don't, or invest in ways that other investors do not, in order to achieve impact that probably would not otherwise happen. So just to bring this back to impact versus ESG, I'm going to invoke a very helpful graph from Tideline, which helps to explain that impact investing has generally emphasized, at least in writing, this criterion of contribution to an extent that ESG has not. So this graph shows that impact investing in the top right there is distinct from other types of investing, or is supposed to be distinct from other types of investing, including ESG, in terms of greater intention to achieve impact and in terms of contribution. So if impact investing is going to remain distinct and important, I think we really need to focus on contribution. But it's also worth recognizing, and I'm sure many of you know this, that the contribution or additionality criterion has been a bit controversial because it seems to imply concessionary returns. That the most intuitive way by which an impact investor can differentiate from traditional investors is to prioritize impact over financial returns, either by explicitly targeting lower returns or more indirectly through a subordinate position in the capital stack or taking on a lot of extra transaction costs, et cetera. Basically, if the deal is financially attractive, the thinking goes it's often reasonable to assume that the counterfactual is that some other purely profit-driven investor would pursue the deal. And so therefore, the degree of contribution is questionable, at least. Now, of course, as we've seen from the GIN data, many impact investors target competitive market rate returns. This is a figure from the GIN's last annual survey, which shows that about 2/3 of the surveyed respondents target risk-adjusted market rate returns. And then this figure from their survey shows that most respondents report meeting or exceeding their financial performance expectations. And there's actually evidence supporting that, there's other evidence supporting that many impact investors achieve market rate returns. This is a forthcoming academic article on the subject, which shows that impact private equity and venture capital funds show risk-adjusted performance similar to that of their non-impact counterparts. And so, given this evidence, it's perhaps problematic to think of contribution in terms of concessionary objectives, given this apparent reality that many impact investors are achieving risk-adjusted market rate returns. And so this is where the issue of difficulty arises. So again, contribution is about achieving value-added impact by doing things that traditional investors don't do. If we're not talking about targeting concessionary returns, then it might make sense to think of contribution in terms of difficulty. In other words, thinking of contribution in terms of taking on work that enhances impact and that traditional investors can't be bothered to do because it's extra work that's not relevant to their profit-focused objectives. And it's reasonable to assume that impact investors are experiencing this extra difficulty because presumably impact investing involves all the conventional responsibilities of investing, plus whatever activities come with prioritizing impact, right? So inspecting earnings reports, following market trends, meeting with management teams, courting potential co-investors, and so on. And then on top of that, whatever work is involved in trying to make a dent in climate change, racial injustice, educational inequality, et cetera. Okay, so before I get into the actual data on this topic, I want to pause and recap what I've argued so far, because I'm putting a lot on the table here, and I think a quick recap could be useful. So first, I've argued that impact investing needs to differentiate itself, especially in the age of ESG, and that requires emphasizing contribution. Contribution is all about what makes impact investors different in a way that justifies that distinct label of impact investor. Second, I've explained that contribution consists of activities that cause impact that likely would not have occurred without those activities, and it's achieved by investing in ways that non-impact investors generally do not. Remember, non-impact investors achieve impact all the time, and the idea of contribution is that an investor who takes on that moniker of impact really should be aiming for impact that we're not getting from conventional market forces. Third, I've pointed out that for market rate impact investors, achieving contribution presumably can't involve investing in deals offering concessionary returns. So the fourth point there is that essentially the other option left on the table is achieving contribution by taking on work that non-impact investors would pass on. And that implies extra work, time, effort, or in other words, difficulty. So that leaves the question, the empirical question, do impact investors find impact investing to be more difficult than traditional investing? So to address this and other questions, I've worked with Professor Catherine Klein at Wharton to develop a survey that we're using to build the Impact Finance Database, which is a comprehensive repository of information on over 220 impact investing funds, particularly in private equity and venture capital. And in that survey, we included questions on this issue of difficulty. We asked impact investors to report on how their work compares to traditional investing when it comes to these activities at the bottom. So sourcing potential investments, conducting due diligence, attracting and securing investors, hiring and retaining employees, meeting financial targets, winning competitive deals, and exiting successfully. And so respondents could indicate that impact investing makes the activity much harder, somewhat harder, about the same, somewhat easier, or much easier. Okay, so now, because we're short on time, I'm going to go straight to what I think is the most important finding from these data. Okay, so here's the most important pattern I found in the data. There's a lot going on here, so we'll talk through this a bit slowly. So we have 7 clusters of 3 bars each, and each cluster, that is each set of 3 bars, presents the response data on one of those activities that I mentioned before. You can see them highlighted along the horizontal axis in the bottom there. So the darkest bars are for respondents who identify as market rate seeking. The middle shaded bars are for those who identify as below but close to market rate. And the lightest bars are for those who target returns that are at or near capital preservation. So those are the most concessionary funds. I went with shades of green because it sort of evokes money to many of us. And so the darker the green, the greater the emphasis on market rate returns. And here, just to simplify the presentation, I'm just showing percentages who reported that the given activity is somewhat or much harder in impact investing. So I've simplified the data just a bit to make it easier to present. So just to clarify, if we look just at sourcing potential investments for a moment, what we see is that just under 50% of market rate respondents think that this activity is somewhat or much harder in impact investing than in traditional investing, while 70% of below but close to market rate respondents think it's harder, and then nearly 90% of the more concessionary respondents think that sourcing potential investments is harder in impact investing. And that pattern holds across the board. For all the activities we asked about, concessionary impact investors were more likely to consider impact investing to be harder than traditional investing. Now, just to be clear, there are other findings we could discuss. We could talk about why all of these bars aren't higher. We could talk about why certain activities seem to be harder overall across the board in impact investing than others, but I only have so much time, and so we're going to focus on these differences among investors targeting different returns, okay? So why do we see these differences? It probably has something to do with the fact that concessionary investors often work with smaller companies with less experienced management in regions that may be more challenging to do business in. These investees may be harder to pitch to co-investors and may also require more technical assistance. So from that perspective, it makes sense that concessionary investors find impact investing to be harder. But on the other hand, if we assume that market rate impact investors are meeting that contribution criterion and therefore pursuing market rate returns while also taking on work that other investors wouldn't bother with, then they should find that balancing act pretty difficult. It's unclear why they're significantly less likely than their concessionary counterparts to view impact investing as harder. And so to gain some more clarity here, I think we need to get deeper into the psychology of impact investing. And to do that, I'm going to draw on some research that I conducted with Lauren Kaufman, who's now at Darden. These are a couple of publications that you can look up to learn more, but basically we interviewed staff at 135 impact investing organizations to learn about their practices. And one of the clearest findings from this research is that it's common for impact investors, especially market rate impact investors, to believe that impact and financial performance are highly correlated in their deals. We actually coded our interviews according to whether that belief and that correlation surfaced in the conversation. And the difference is quite significant. This is the breakdown we came up with after comparing our coding. 73% of market rate investors made this claim of seeing a win-win between financial performance and impact in their deals, while only 22% of below market rate investors made that claim. Now, in practical terms, what we found to be the result of this mentality is that market rate impact investors were more likely to believe that they can proxy the impact performance of their investees essentially by measuring their business performance. Now, doing that obviously simplifies things considerably, and here are a few illustrative quotes from market rate investors demonstrating that simplification. I'll just read these very quickly. The more financially successful, the more impactful, the more financially successful. Another market rate investor says, our impact strategy is built into the business strategy, so we don't have to try too hard to measure impact because it's already built in. And then the last quote there is, in essence, the KPIs for social impact are inherently built into the financials. So you can glimpse here how some investors view impact as something that's very intertwined with business performance, with the result that it really simplifies impact measurement. And in fact, what Lord and I found in this research was that a lot of impact evaluation is actually financial performance evaluation, particularly for market rate impact investors. The impact assessment in impact investing is often very front-loaded. Most of the attention to impact happens during screening and due diligence. And once an investee is deemed impactful, a lot of what the investor does is basically conventional investing work. Impact measurement itself is often used at that point more for marketing and communications to advertise successful investments, not so much for true performance evaluation and impact management. And again, this was especially the case for market rate impact investors. Now, this interview research that I'm referencing here pertains specifically to impact measurement, but the basic underlying idea of this fusion of impact and business performance likely has similar implications for other domains of impact investing as well, such as the ones we focused on when collecting these data. If you believe that impact and business performance are highly correlated, then you can think of any business enhancing work you're doing as something that doubles as impact enhancing work, which is why I think we see that market rate impact investors are the least likely to perceive extra difficulty in these activities. Now, in terms of contribution, this raises serious and interesting questions about whether and how often impact investors are meeting that important standard for achieving value-added impact, because again, it seems likely that a lot of those value-adding activities pertain to enhancing business performance and are therefore likely to be quite similar to what non-impact investors would do as well. Okay, so I want to pause here and recognize that I'm making some arguments that might seem a bit spicy, a bit provocative. So I just want to take a minute to clarify what I'm arguing and what I'm not arguing. So first, I am arguing that there appears to be a pattern where market rate impact investors are more likely to simplify the work of impact investing by viewing impact through a more financial lens. I am not arguing that this is the case with all market rate impact investors. We all know of examples of market rate seeking impact investing firms that prioritize their returns and also engage meaningfully with impact as a distinct and important concern. Second, I am arguing that the data suggests that much of the work that many impact investors, and particularly market rate impact investors, are doing closely resembles what traditional investors do, especially after due diligence. That's the finding with impact measurement from my past research, and it's what these data on reported difficulties seem to be suggesting, though I do think this needs more looking into. I am not arguing that because this work closely resembles the work of traditional investing, it therefore is not impactful. So just to clarify, it can definitely be impactful, and there can definitely be a strong correlation in an investment portfolio between impact and financial performance. But the point here is that all investors and all investments have impact. And what's supposed to make impact investing special and unique is the premium placed on positive impact and the counterfactual thinking that goes into ensuring that this impact is above and beyond what we're getting from conventional market dynamics. Impact investing, at least to my mind, should not just be piggybacking on the impact that we get from any investing activity. So just to illustrate that point, when we look at, for example, this guidance on demonstrating contribution from the IFC's operating principles for impact management, there's this footnote, which I've highlighted, where they give examples of contribution, many of which would seem to apply quite easily to traditional investing, right? So improving the cost of capital, active shareholder engagement, creating long-term trusted partnerships, providing technical assistance, helping with operational standards. These are all potentially great ways to optimize impact, but they're also examples of what non-impact investors frequently do, especially in private markets. So we need to be careful about understanding when and how these activities are deployed in ways that optimize impact beyond what a traditional investor would accomplish just by trying to improve business performance. Now, I admit that it could seem that I'm being a bit too fussy about standards of contribution, but again, the context here is that I think we're at a time when impact investors need to be more deliberate about differentiating their practice. So underlying this whole topic is sort of an existential question for impact investors, which is, what is the purpose of impact investing? So should it be the vanguard of the responsible investing movement, or should it be just sort of a synonym for it? If it's the former, if it's the vanguard, then we need to start thinking of impact investing increasingly as impact first investing, catalytic capital, all of these models that really stand apart in terms of contribution. And to be clear, there's definitely a place for achieving market rate returns in those models, but my sense is that achieving market rate returns under those constraints should, generally speaking, be hard, or at least it should be harder than it's looking right now. Okay, so in this last minute, I'd like to wrap up by, again, briefly recapping the main points of my argument and drawing out the practical implications here. Again, I put a lot on the table, so I think another quick recap would probably be helpful. This one will be a bit briefer. Okay, so here it goes. First, again, impact investing needs to differentiate itself, and that requires emphasizing contribution. For market rate impact investors, which is a sizable chunk of the sector, achieving contribution can't involve targeting concessionary returns. So in this case, achieving contribution would seem to require taking on work that non-impact investors would pass on, and that implies extra difficulty. But market rate impact investors generally do not find impact investing to be harder than traditional investing. And part of the reason, I think, is that they often equate impact and business performance, which enables them to view normal investing activities as impact optimizing activities for investees that are deemed impactful during screening and diligence. And of course, this tendency raises the serious possibility of marginal levels of contribution, particularly among market rate impact investors. Now, there are two basic takeaways here for impact investors and for the field more generally. The first is that we really need to elevate and emphasize contribution as a distinguishing feature of impact investing as a movement that's distinct from ESG or responsible investing more broadly. And second, we need to probe and question this fusion of business-focused and impact-focused work. We need to really seek out evidence of value-adding activity that traditional investors would probably not carry out. So in terms of the practical matter of evaluating reporting contribution, there's a real need to engage in that counterfactual thinking exercise with reference to what we know about what traditional investors do. So again, helping with operational standards, for example, might be great for optimizing impact, but if we have good reason to believe that any competent, profit-driven investor would take measures in this case to help an investee with setting or meeting operational standards, then we need to look beyond that for evidence of contribution, or we need to be quite confident that traditional investors are just not working in that particular market. And I think a good indicator of all that is the degree of difficult extra work that the investor is taking on. So I'm going to wrap it up here. I'm eager to hear what you all think, and I'll just thank you for your attention and for your time. Hopefully that wasn't too fast. I wanted to leave plenty of room for discussion.
I can respond. First of all, thank you. That was just an incredible summation. This is incredible work, and it's like very core to what I'm doing as a practitioner in the field. And I think about these kind of things daily, and just, this is really great work. And I look forward to supporting you more on this. I just think I agree with most of what you said. So this is just like a really niggling point, but I think the difference between ESG and impact is very clear. So like impact is what the company does, and ESG is how the company does it. So it's how like Elon Musk can actually, there's all these like unintentional impact investors that don't even self-identify as impact investors. So like Elon Musk maybe, right, is a good example. Like he really, say what you want about Elon Musk, he like really led off this electrification of vehicles and really transformed the whole industry in doing that. And I think he's an impact investor, but he's like just a financial first impact investor. And then with ESG, it's like 100% of the companies in the world can be ESG, whereas only maybe like 5 to 10%, even in the best case scenario, can be impact. So I think that just leaving that, like making that distinction very clear and then leaving out, and then there's a whole nother subsection of people that are like intentional impact investors. And for them, I think, these issues, like very difficult issues about how you prove actually your additionality, are very important and should be explored and, developed.
So thank you for that response. And I think it's interesting, this is sort of I wish I had teed up like one of those Zoom surveys where I can just like ask the room, how clear is the difference between ESG and impact according to you? Because I think that, I think that you can make the distinction clear in a framework or an infographic, but when you aggregate all those frameworks and articles and infographics, like, is there a clear narrative that emerges? And is there, and if you poll a room, is there confidence that people understand consistently what the difference is between ESG and impact? Because you'll hear the distinction that you describe, which is that ESG is how it is, what a company does, and or how it does it, and impact is like the actual product impact or service impact, like the actual effect it has on the world or on customers or whatever. But there are other versions where, some will say ESG is all about materiality, and it's just using impact considerations to determine possible financial performance, whereas impact investing is more about targeting impact as a primary objective, not just as a means to a financial end. So there are other, and then there's other sort of more tangential distinctions, like, impact is private markets, ESG is public markets. So there are all these different kind of schema that I've come across, at least in conversation and reading. And I remain pretty confident that there's a lot of confusion over what impact and ESG is among non-experts. Like, for you, it might be clear as day, Sarah, because you're very much plugged in. But for, I think, the average observer in the field, I think this remains pretty murky.
Okay, well, I buy your counter argument that I probably only talk to people that define words in the same way that I do. And I just want to say that my schema is the right one. And so we should perpetuate this in the world.
Point taken.
I think that's very interesting, Sarah, because I thought that we had all agreed that intentionality was part of the definition of impact investing several years ago. So that piqued my interest that you said, well, you don't even have to be intentional about it to be an impact investor.
Yeah, I mean, I always say Zoom is like the greatest decarbonization startup that ever has existed in the world. But they don't even measure it. They should, but.
So I think that, and thank you, Hannah, I do think that intentionality is a necessary but not sufficient feature of impact investing. And that timeline graph that I shared in the presentation, had two axes, intentionality and contribution. And I think there was a debate in the early 2010s about, like, is intentionality sufficient? And I think the consensus over time was that it's a good starting point, but you really need to, it's too easy to profess intentionality, and so there needs to be a bit more to it than that. That was my reading. Yeah.
And maybe just to also, I think the way that what Sarah's saying is can be consistent with that definition is that you have intentionality at different levels. So if you're an impact investor investing in Zoom because of the decarbonization benefits, great, you have intentionality around that. It's not necessary for the portfolio company to have the intentionality that you do. But for the investor, intentionality with measurement, and now you're adding, with contribution or with some kind of action, some kind of work. That's what is the distinction. I have to say, I do agree that yes, for those of us, many of us who work a lot in the space have at some point felt clarity about the distinctions. But for me, I constantly cycle between clarity and feeling like, okay, I can make a really rigid framework in my mind, but there's always examples and different things where the edges bleed. So I like the general idea that yes, we should find ways to continue to make that distinction. And so I guess then that brings us to your specific, these specific findings and takeaways. And I actually wondered, this is kind of data geeky, but in terms of the data that you showed with the responses from the different investors, market rate investors, I think market rate impact investors are also often biased toward not admitting that it's harder, or because that makes it seem then like there's going to be some kind of trade-off. And to be able to sell the concept to our investors, it sort of needs to be like neutral, you're going to get kind of neutral or better. It's market rate investing plus impact. So yeah. I do wonder a little bit about that, because at least, and I think you're also right that there are a lot of market rate impact investors for whom it's a simplification mechanism to say it's really, these things are really too tied together. They're one and the same, the financial and the impact performance. But for those of us who fall in the other camp that you talked about, where we're doing market rate impact investing and we're putting a lot of effort into the into the impact piece of it, it is hard and it is a struggle to figure out, I think, where do those resources come from, and to put that emphasis on measurement and action. Just one more small point, and maybe at the risk of rambling, but some of the things that you mentioned that impact investors do, that regular investors also do. Yes, but we might be doing the same things, but with a different goal or different results that we're aiming for. And an example would be, as our private equity team sits on the boards of companies, and generally tries to improve certain aspects of operations, of governance, a lot of it is with an impact lens, and with the goal of, trying to make sure that there's a rigorous focus on the target segment that we want them to stay involved in, or on, improving gender equity, or whatever these particular things are. And so I don't know if it's enough to just say, okay, well, if you're doing all the same things that typical private equity investors are doing, then it's not contributing anything on an impact level.
Well, so thanks for those points. Let me address. I think that there are two main points there that I want to respond to. First is this interesting and really incisive point about bias in the data. Our market rate impact investor is more biased to reporting that there's no major trade-off, there's no extra difficulty. That's a really interesting point. All I can say to that is that this was always messaged very clearly as an academic undertaking. We're not an LP. We're not evaluating the fund publicly or anything like that. We're just a bunch of nerds at universities who want to study this, and this is totally confidential. And so that is the context in which the data were shared. And then I have to say, in the separate project where Lauren and I interviewed 135 impact investors, it was the same messaging, and it was also a conversation. So you can do a lot in a 60-minute interview to sort of break down some of those defenses and those biases, and nevertheless, we still got this not across the board, but in general, we got this confidence in this happy win-win between financial performance and impact performance. So that's I admit that there could still be a lingering bias, but we did take effort to minimize that as much as possible. Now, as far as the point about how impact investors can do the same thing as non-impact investors, but with different objectives or different results. So let me just, I think there's a need for some extra nuance here. I essentially agree with you. So I think that, but what that means in my mind is that they're not actually doing the same thing. So I'm really taking aim at underspecified language, right? So in the IFC's operating principles guidance, when they say operational and technical assistance is a way of demonstrating contribution, what I'm saying is maybe, but it really depends on the details of what you're doing in that operational and technical assistance. So if a fund is reporting operational and technical assistance in their disclosure for alignment with the operating principles, and it's verified by Blue Mark or whatever, I would say that that's not clear enough. There needs to be more detail on what exactly you're helping with. If you're helping with the optimization of impact, then and in a way that's different and distinct from what a non-impact investor would do, then I'd say that checks the box. It remains operational or technical assistance or whatever, but it's just there's greater specificity there.
That makes sense. Thanks.
So I see a question here from, sorry, Mike, should I be just taking the questions? Okay. So I see this question from Lauren Zullo. Did you get a sense of the interviewee's background? For example, was it more likely that a market rate impact investor came from traditional background than a concessionary investor, or was it pretty equal? Good question. From what I recall, it was common for market rate. It was more common for market rate impact investor respondents to have experience in traditional non-impact investing. That was another question that we included in the survey. And this is a good opportunity for me to elaborate. When I took that into account, the patterns that I found remain largely the same. So that trend remains even when you just restrict the sample to respondents who have experience in non-impact investing as well.
Okay. Thanks. Yeah, just wondering if it was sort of like a perceived difference issue rather than experienced.
Yeah. really liking just how clued into research processes and biases and all these like confounds people are on this call. So it's really refreshing.
Because we're impact investors.
Yeah.
I have one kind of just, I don't know, general thought on the industry and where it's going, especially with regards to the regulatory schemes emerging in kind of Europe and the US, and how it's sort of classifying impact investing as just essentially a subset of ESG investing is sort of where it's trending. And, I think Sarah's question or point about Musk and Tesla was kind of interesting to me, right? Is Tesla an impact-oriented company simply because of the sector they're in, because they're in EVs? Is that, and it's having an impact? And so as you were speaking, it was raising questions for me. I'm at a private equity real estate firm, and we invest in affordable housing, the preservation of affordable housing. And we have strategies that add resident services, and we do kind of, deep greening of the buildings. And so I feel like we have layers sort of on top of that specific asset class. But would we then potentially think of, right, if we're talking about kind of additionality and investor contribution, we certainly have peers in this space that are achieving market rate returns. We're achieving market rate returns, risk adjusted. But I'd say almost anyone kind of exclusively investing in affordable housing is kind of operating in that impact space, at least as it's perceived in the market. And so I guess you're just, I don't necessarily have a point, but you're kind of just making me think a lot about what we're doing. And so is it enough to even be investing in, building EVs or preserving affordable housing? Is that enough to be impact? Or are those people not impact anymore unless they're kind of going above and beyond with these kind of with these additionality and investor contributions?
Yeah, I think it's a really good question, and it kind of implies another question, which is a little bit uncomfortable to talk about sometimes, but it's important to address. So first of all, so there's money to be made in affordable housing, right? That is a market where you can do well, and so I do think that there are good reasons to invest in affordable housing from a purely intentional point of view with impact interest. But yeah, I think from my standards, to be an impact investor investing in affordable housing, you need to take on the extra work that you've described. I think engaging with these properties, with these managers, to actually restructure operations to make it even more impactful. I think that's what merits the moniker of impact investing. And what that means, I think, is that if we see an aggregate shift in capital markets in general towards more impact, then it has to shift impact investing as well, right? Like impact investing, I think, should be the vanguard of the response of the vision for how capital markets can work for socially oriented objectives. If capital markets shift overall towards that schema, then impact investing needs to shift with it and needs to be more and more pioneering. I think that carries potential problems from a field building perspective, because the bar becomes higher and higher and higher. But I think it's a good problem to have if we have it.
Thanks for those thoughts.
I see that, I'm sorry, Belissa Rojas, if I'm pronouncing your name correctly, I see your hand is up. I'm not sure how long it's been up, but please feel free to chime in. Yeah.
Thank you. Well, thank you very much. It was super insightful and very interesting. So first of all, thanks about that. I just wanted to share with you all that many times also the terms we're using as synonyms, for example, additionality sometimes and contribution. And I come from the multilateral development banks area, and additionality usually is different than contribution, right? It's really about financial and non-financial inputs that make the project or the investment happen, right? And it's really related to the fact that if you think about these organizations, they have funds that come from taxpayers, right, and donors. And basically, they want to make sure that financially they are helping to make things happen that otherwise wouldn't, but from a more investor perspective or technical assistance perspective. And it's not exactly the same as contribution in the sense of the counterfactual of the design of the project per se. So you can have it, let's say, at the company level and at the investor level, if that makes sense. And sometimes the term is, we use it as synonyms. And I think even, IFC in the aim is also confusing, but I just wanted to say that maybe asking the question, at which level are we assessing it? And that's why, and I agree with you, I think based on your definition, it's kind of a little bit, not enough. But when you use their definition of MDBs, and they have some papers on that, they are trying to do something else that's different from contribution, right? So I guess just to add that the ESG and impact terms and all those confusion, well, now we have the same with additionality, contribution, and all that. And just to consider those variables, right? That is not as obvious, and we just need to think, what are we really talking about when we assess the tools? Yeah, that's all. Thank you very much.
Of course, thank you. So I haven't been as good as I could be about looking for hands raised, but I see Cornelius, you have your hand raised.
Hi, yeah, thanks, Mike. Very thought-provoking discussion, and thanks for all your good research and sharing your findings. Just going back to your prompt, in terms of the rising sort of interest, popularity of ESG investing and whether it comes at the expense of impact investing, I was just curious, based on your research and understanding of the history of the growth of the ESG sort of investing field, are there any lessons learned for why, it's taken off more rapidly than traditional impact investing, or how we would define impact investing? And what are the implications for, I guess, future efforts to really galvanize interest in popularity and impact investing, similar to how ESG investing is caught on in popularity?
So I just want to make sure I understand the question. So what would I attribute the striking rise in popularity of ESG to, as opposed to impact investing?
Yeah, because it seems like, based on your research and what you've shown, ESG investing has become a bit more popular in terms of just user, searches on Google, for example. But I also know there's ESG reporting requirements coming from the EU. Obviously, I don't think, based on my knowledge, impact has that yet. So is there any lessons learned from the growth of ESG investing and why it's taken off that could be potentially applied to scaling up impact investing, which I think was part of your original prompt? Yeah,
I don't know if I have a confident answer to that question. I have some speculations to offer. I think that impact investing has sort of an international development and sort of origin to it, and it's been associated with private markets, at least in its infancy. So it had sort of a more niche kind of origin story, whereas ESG was always sort of public markets, integrating these criteria into large cap public companies. And so there was just like more momentum to build on in the first place. I think that the Fink letter in 2018 has something to do with, that came right before that rise in interest, and that was addressed more to ESG in public markets, I believe, than to, what impact investors were doing primarily in private markets, emerging markets. So I think that there are just sort of different origins that these movements are coming from, and the ESG origin just offers greater kind of greater volume, which is why it's had greater interest in that way. But it's an interesting question, and one that I'll continue to think about. That's what comes to mind right now. So there's been some activity in the chat. I'm not sure are there any questions addressed to me here, or not a great moderator, sorry.
So I'm gonna take ownership of that, because I've been contributing to the distraction. We're just really inspired by this concept of whether there's a static definition of impact investing, or if you actually sort of if you have to constantly reposition yourself to be on the margin, even as the bar gets raised, in order to be an impact investor.
Yeah,
yeah, the word hard was really interesting, because Mike says there's, as the impact, as the norms of what other investors are doing raised, the bar gets raised, impact investors are pushed to the frontier. But this notion of hard also implies that as the impact investor gets good at their job and starts to find it easy because they've got good routines, they should be pushing to the edge of their frontier too. So the notion of hard is so relative, And to say that impact investing should be hard, you have to be on the edge, not only relative to the mainstream, but relative to your own competence, which I find a fascinating definition.
Yeah, and you know what? I might have to just admit that maybe my title is a bit oversimplified, because the question, I mean, it's a useful question to ask, but technically from the survey, the question is impact investing harder than traditional investing, not just hard in an objective sense, right? So I think that's the real focal question. And I do think that there are two alternatives that I'm imagining right now. One is that all investors begin to identify as impact investors, which seems unlikely. And the other possibility is that there remains a segment of the market that just decides for whatever reason to opt into that designation, and it remains a relatively small piece of the field. And the rest of the investors are, beholden to whatever public regulations come out and whatever cultural norms are prevalent, but just don't go as far as that subset of investors that have decided to put impact in front of investor when describing their activities. So I do think that there ought to be, if that's the case, a continual shift where impact investing just always seeks to be more and more value added above whatever value is we're getting from just Pfizer developing the COVID vaccine, the reconciliation of supply and demand, Tesla, all these things, that all the impact that we're getting from conventional market dynamics.
I'll just chime in here and say that I think an important aspect to these conversations is like, why are we even thinking about this stuff? And to me, we need to be thinking about it from the perspective of an investor who has a pot of money and is going to put that money somewhere. Either donate it to a nonprofit, invest it in, market, non-impact stuff, or invest it in an impact investor. So I have a lot of investors in my fund that are just investing for performance, and they're non-traditional impact investors. For example, Peter Thiel is one of the largest investors in my fund, and he hates impact at all, totally. But he's still an investor in my fund. And I think so I'm in communication with these people a lot. And additionally, Mark Andreessen is also an investor in my fund. He hates impact investing. We're definitely the only impact fund that he's in. What these people would say about this whole conversation, it's not necessarily what I believe, but I think it's important that these kind of voices are in the room, is impact investing is stupid. I would never deploy my impact investing money into an impact fund because I would have more impact actually in terms of the things that you want to do, like create equality and innovate, investing in these non-impact funds, because you have these kind of innovation outliers, etc. So I think by narrowing the topic in this way that has been discussed in this call, we're narrowing it in a way that makes it non-useful it makes it more useful for people that have already identified as impact investors, but it makes it less useful for people that are starting from the question, where should I deploy my money to have them to do the most good in the world?
Mm-hmm. Yeah, I guess it all depends on which audience you care about. I mean, you should care about the audience that has more money. Well, I mean, I don't manage a fund. I'm a researcher who cares about impact investing as a movement. So that's my priority. But I totally get it. I am totally sympathetic to the balancing act that the GIN has had to execute, where it's we want to build the field, but we also want to be consistent and we want to maintain definitional integrity. So the whole big tent approach that they've taken, I understand where they're coming from, but they have a different set of priorities than I do. I have the luxury of just looking at these data with my own particular priors.
Michael, I have a question building on that, which is that, so I've only heard this, I've heard you give this talk twice, once to a group of evaluators and then once to this group. And I would have expected much more pushback than I've heard the 2 times that I've heard you give the talk, but I haven't heard you give this talk to like the gen audience or to a mainstream audience. Do you find yourself getting people who are just like, to whom this is completely anathema, going to their own direction? Like, how much pushback are you getting?
I haven't gotten much pushback, and I'm not sure if that's, I mean, I'm not sure how many of the investors on this call are considered market rate seeking. I mean, if this rubs anyone the wrong way, like I do want to hear from you, but no, so far I have not gotten any pushback, and it could just be because those kinds of investors wouldn't plug into this kind of event in the first place, or because they just rather be quiet. I have no idea.
I propose a session at Stoll World Forum with Michael Brown, Martin Dreesen, and Amit Bori.
Well, maybe ICM is a logical next step, and then we can talk about it.
Oh, there we go. Okay.
Hey, Michael, I have a quick question. By the way, I was one of the folks that participated in your survey with Lauren back in the day, and I was at Rockefeller. I think where I find it's kind of interesting where the lines are blurring is around the thematic investor and the impact investor from like the market. And I wonder in your survey, like I may be a thematic investor that identifies as an impact investor, and that could possibly skew some of those results. You know, I have a mandate to invest along, for clean tech, and I look at all the clean tech funds and I can invest in that, and I think I'm an impact investor because clean tech is good. It's just part of that theme that I've identified. So I think that's I'm kind of curious where that, as you do your research, how that line blurs a little bit, like the mainstream.
So just to clarify, are you asking about like the respondents that we got into the funnel in the first place, and like how many of them are?
Yeah, I'm curious. Yeah, it's just more of a comment and a curiosity, because I feel like a thematic investor may consider themselves as an impact investor, and how you define, how do they get into the funnel, or do you even separate that out?
Yeah, the first question that you get when you take the IFD survey is just like, what are your priorities when investing? And the standard that we use is, let me just bring it up. So if you check the box for, we seek to invest in companies and projects whose products, services, or business practices have a direct positive impact on society or the environment, then we consider you an impact investor, or within that impact investing universe. There are other options that you can check, like, we screen out investments that do not meet specific ethical guidelines. You can check both of those. But yeah, we do, but the vast majority, like 96% of the respondents we get, check that first box for what we consider to be impact investing. But I agree with you, there's a whole range of identities within that box that may be, more or less impact investing by other people's criteria. Well, so I'm not sure if there are any other questions. Mike, did you want to say anything to close out?
No, I think this is just terrific, and I'm so grateful to you for the work that you've done and for being willing to share it. And wanted to stay out of the way and let all of these people ask you their questions. So with permission, we've recorded it, but we're going to try and put it on YouTube. And maybe we can twist your arm to do a similar talk for Impact Alpha. That might be the next step towards the libertarian mega wealthy people of the world.
Can I also just ask what's next? Like, is there a publication or further research, or what should we look for?
Yeah, I mean, that's a good question. I'm not sure. There's a version of the next step, which is like, we just put an article out, so basically the article version of this presentation in like, Stanford Social Innovation Review or whatever. Or we could do that and collect more data, perhaps more qualitative data to round out these quantitative data to get a better sense of, why we're seeing these patterns. The immediate next step for me is to tell my colleagues at Wharton and Harvard and Booth that people are interested. As Mike noted, not getting a whole lot of pushback. People seem to find a compelling argument, and we'll sort of confer and decide what to do next at that point.
Thanks. Thank you so much.
And let me just say, if anyone wants to continue the conversation, if anyone has a question that occurs to them after we log off here, please feel free to reach out to me on LinkedIn. My given name is Maoz, M-A-O-Z, and so you'll see Maoz parentheses Michael Brown on LinkedIn, so it's hard to miss me. And I'm always happy to connect and just sort of talk about this for a while. I did that with Jackson for a while, so he knows that I'm happy to have a drawn out LinkedIn correspondence about these wonky topics.
Michael, thank you so much. This has been really stimulating. Really appreciate it.
Sure, my pleasure. Okay, take care, everyone. Thank you.
Everybody have a great day.